there's been a lot of talk today about liquidity being particularly tight. So what do we think has changed in the last 2 to 3 years that have made people more worried about liquidity today?
I think, first of all, I'd like to reply to your first question about liquidity before coming to the evolution. I think the question, or the answer to your question is, should there be more banks to this industry? And my reply is yes. Let's find a solution to get more banks on board and to spread the risk amongst the banks. And if we look now at India, which is a different country with different solutions, you have syndicated facilities, you have spread risks, and I sometimes wonder, why can't we get that organized in Antwerp?
So would ABN go as far when it comes to other banks in actually, putting its money where its mouth is and saying, guys, we're going to lead a consortium. We're actually going to change the way banking works and educate other banks and pull them along with us beyond simply encouraging and giving people presentations?
I think, once again, the question you first raised was, are the existing banks willing to put more money on the table? I don't think it's a sustainable future, because then again this industry, and especially in Antwerp, is depending on 1, 2, 3, 4 banks, and that's it. We need to make sure other banks get comfortable and we're willing to put our shoulders under it. We always say we have a lot of know-how. We don't know everything, but we have a lot of know-how. We have a lot of experience. We have our borrowing-based system, and we are willing to share this in a consortium, but it creates possibilities. When you have, for example, a bilateral agreement right now with a company for 50 million, and you have 1 or 2 banks who step in the industry, and you can spread with the other banks, then you can not serve 1 client, but you can serve 5 clients. And I think that will be crucial, to spread the risk on the side of the bank and to spread the risk for you on your bankers as well.
I think that a syndication does 2 things. A, whilst respecting client confidentiality, it creates a greater spread, as Anish said, of information to the banking participants, which is a good thing. But also not stated is that for a syndication to be successful, there has to be a higher level of financial transparency and financial disclosure. All of these things, I believe, will lead to a more open dialogue between the industry and the banks, and this ties into, Anish, your earlier comment made several minutes ago, would the banks be willing to provide additional financing? I certainly think the goodwill is there. The question then is, will the industry sufficiently change to allow that to happen? And again, I'm optimistic. I kind of throw out a challenge, if you will, to Antwerp, which is the #1 market, both for ABN and Standard Chartered Bank, that this would be a wonderful opportunity for Antwerp to then retake, if you will, its leadership position in the global industry.
Sabine, would you welcome it if, from an ABN-AMRO perspective, would you welcome it if producers offered credit to their customers?
I think, would we welcome another bank to enter the industry? Yes. Whether it's a producer or a bank, for me, it's offering liquidity to the industry. I do see that they are imposing a lot of conditions to the industry, and that can only help to create more transparency. And if sufficient transparency is there, I am convinced and I stay positive that newcomers will come on board.
I mean, one gets the feeling that the strategy of producers, probably rightly so, and we're talking about producers in this part of this discussion, is to max out the rough price. In other words, if people are willing to buy diamonds, rough diamonds, at the current prices offered, then the rough pricing of a producer is correct. And I think Philippe Mellier was on record saying, I think a couple of weeks ago, that it's really up to traders and manufacturers to determine their own level of profitability and to take full responsibility for their own profitability. Kishore, in your opinion, is Philippe right?
I, as a banker, want my clients to be financially strong. And if they are financially strong and they are engaging in a business model that makes them financially stronger, then I would want to, pursuing my own self-interest, provide them with a greater liquidity and greater financing. So the business model, if you will, of the industry has to tie in with a business model also of the miners. I think there's too much of a conversation is based on a zero-sum game. I don't think it's a zero-sum game. And I think if you look at De Beers' prior practice of the past decades, they also did not view it as a zero-sum game. They also realized that the best thing for De Beers would be a client base that has the ability to be a steady and long-term buyer. That type of a client would be attractive not only to the principal banks that lend to the industry today, but also would provide a strong inducement for new banks to want to come into the industry.
What is your opinion on the current rough producer pricing policy? And what we've seen, just as a kind of background here, is that over the last two years in particular, rough producers have adopted a strategy of what we call fully priced rough. So in other words, the price at which they sell rough and the price at which rough trades on the secondary market is more or less the same. Some would argue that actually producers are more expensive than the secondary market. But from a banker's perspective, what is your viewpoint on the current producer pricing policy in general?
I think the people who really have to answer that question are the people who buy the rough. It has to make sense. And when we provide financing to a client, we clearly look at what is their purchasing and what is the margin that is inherent in the overall activity. And there clearly have been certain changes in the past several months. Time will tell whether such changes will be sustainable. The mining companies have been reasonably vocal in encouraging the trade to change their business models and take a more adaptive approach for changing circumstances. Whilst I applaud that, there's a good old English phrase, what's good for the goose is good for the gander. I think if the trade needs to take a more adaptive approach, it also would not be bad for the mining companies also to see how they should modify their business practices in a way that would also support good health for both sides going forward.
How do we think that ADB's exit from the trade, which is about 10% of the market, is going to affect rough producers?
The rough producers need their customers to be able to fund their purchases. So when you take something between 5 and 10% of the available liquidity out of the market globally and a much bigger chunk out of Antwerp, clearly that has a very serious implication for the people who are selling the rough. To some extent, it has been alleviated by the behaviors of two of the larger producers in deferrals. Of course, what happens from here is important, but those decisions to allow deferrals in the early part of this year until this week clearly helped the producers. But in a way, I think the question within what Anish is saying is, when you take $1.2 billion of available debt out of an industry over a period, 2-3 years, whatever the period will be, how do the producers adapt to that? One of the ways they're going to have to adapt to that is, as De Beers says, and as Rio Tinto has said actually, we will sell according to market demand. Now, in the diamond industry, this is quite an important statement because in the iron ore industry, there's piles more iron ore than we need, and the iron ore price is more than halved. Nobody wants the diamond price to more than halve. There's a confidence issue here. There's a working capital issue. There's a buy high and sell low issue for many of the people in this room. Now, the producers are going to have to get used to that, because over a period, there must certainly be a slimming down of the industry. There's just less money to support it, or there's got to be a source of new funding, be it equity or new banks. But as I referred to earlier, I suspect one of the problems is that there's a chunk of debt within that pipeline that doesn't truly belong in the diamond industry. It's not supporting working capital that is needed to do the final sales in the stores. So I think the diamond industry and the producers are going to have to be more cognizant of, as De Beers and Rios have publicly said, selling according to demand. Because if I may just bring in an example from the zircon industry, which is a bit of an unusual one, but zircon is used in ceramics. And there are a few very big producers. It's not unlike the diamond business. And the zircon price went from $1,000 to $3,000. And everybody thought you could sell just as much as 3,000 as at 1,000. Well, the fact that it went to 3,000 was anomalous in that it was because of certain market imperfections at the time. So the big producers, when the price started going down, said, well, we're going to restrict. It didn't stop the price of zircon going to $1,000 again. The diamond industry doesn't want that. The diamond industry really does not want a lack of confidence in the price of rough or polished. It's just really not helpful. And I think the big producers in particular, and I suspect increasingly the small producers, will have to recognize that.
Des, I mean, just to try and put you on the spot here, just in terms of guess, and please give a range here. If bank credit in our industry between today and tomorrow fell by 10%, what do you think would happen to rough prices?
As an economist might say, ceteris paribus, or other things being equal, they would come down. Of course, a lot depends on China, the continued growth of the United States, hopefully a sustained recovery in Europe, and the ability of other funding sources to come through. But you know, a term that I've heard used in recent days is, if mortgage finance is not available, what happens to the price of houses? Clearly, the diamond industry is in much the same boat. If finance is not available, the price of rough, the price of polished must clearly be constrained.
And thank you very much to the panel for responding. And if you could just join me in giving a big round of applause to the panelists. Thank you very much. Thank you very much, Sabine, Des, and Kishore.